Hello everyone, Bill Parish here from Portland, Oregon, and this is the second in a series of videos on private equity and hedge funds. What's fascinating to me as an SEC registered investment advisor is there's all this talk of banks. In fact, there's a big demonstration today here in Portland on Occupy Wall Street. You see big articles in the Wall Street Journal regarding banks and how they've supposedly misused their TARP funds, but you don't see many articles on the private equity and hedge funds, and they are the big inside story. So again, this is the second in a series. I'll explain the key parameters of what's going on, and I hope you'll find this information useful. The first thing to consider with respect to private equity and hedge funds is that they charge an annual management fee, generally 1 to 2%. And then on top of that, they earn what's called carried interest. Carried interest is basically, if I go ahead and invest 3 in a company, okay, and that private equity, from once they return my original investment of 3, they're eligible to earn 20% of everything they return to me above that. So let's say they give me another 3 on top of my original investment. Okay, so they're going to earn 20% of that, a huge fee. Generally, it's about 10 times their annual management fees. Well, again, this has nothing to do with profitability. What's the easiest way in which the private equity or hedge fund gets to the carry, what they say, the race to the carry, is they take the company, they load it up with debt. Let's say I've got 3 chips worth of debt, okay? They load the company up with debt, okay? And then they rather than reinvest those proceeds from the debt in the company, they take the debt out and pay themselves. They may pay me, the partner, first so that they can again get to the carry. So it's a little bit confusing. To make a long story short, the game is a race to earn the carry fees, and the way you earn carry fees is to return cash to your original investors. Once you return their original investment, you get 20% above everything beyond that, and the fastest way to generate cash to return is to load companies up with debt. That's the big untold story of these private equity hedge funds. They are debt-making machines, or debt-making job destruction machines, basically. So it's a race to earn the carry fees. And what's interesting about the United States is the way carry fees are calculated is different from Europe. Here in the US, we allow what are called deal-specific carry fees. Okay, and what that means is that if KKR has a fund with 4 investments in it, they don't have to return the cost for all 4 of those investments to be eligible for carry fees. Okay. If they have 1 investment here, and let's say they return the cost to Oregon PERS for that, then they can earn 20% above whatever is calculated for this particular investment. So again, the point is that they don't have to return the cost for all of the specific investments in the fund, but they can instead earn what they call deal specific, meaning specific to a particular company carry. And you may think, well, what does that matter? What does it have to do with? Well, again, as taxpayers, we're paying these carry fees because we're funding the public pension systems, regardless of what state you're in, city, county, state. We're paying the carry fees ultimately, right? And I showed you in the previous video, the Oregon State Treasury doesn't even keep track of these carry fees. They're, I said hundreds of millions, but they're billions of dollars. They don't even maintain independent records, and they've got a $10 billion portfolio. Again, here's the response that I got when I did a public records request from the state of Oregon. But let's take a look at another significant issue. So if they're going to be earning carry fees on this particular investment, let's say KKR does, it's predicated upon these remaining investments being valued above the cost. Okay, so who does the valuation of these remaining 3 investments? KKR. Okay, how do they value them? They value them based on economic net income times a multiple. Most companies, when they report their financial statements, like Intel, Eaton, Conoco, they show net income. Private equity firms do not show net income, or they don't focus on net income. They show what they focus on is what they call economic net income. Now, that may not seem like a big deal, but the strange thing about economic net income is they're excluding key costs from income. So they're basically using inflated valuations. And if that is indeed what they're doing, they are earning carry fees they're not entitled to. And this could be a very significant amount. And if you think this isn't a big issue in terms of valuations, take a look at this piece from the Financial Times, just one simple example of how private equity valuations can diverge, explaining how Blackstone and TPG owning the same investment at the same time, Blackstone valued their investment 150% higher than what TPG did. And we're talking about a very large company. So the valuation of these is really critical because, again, if these are overvalued, public pensions, teachers, plumbers, government workers, we're all taxpayers, we're all paying carry fees that they're not entitled to. Okay, so I think it's wrong for them to be using economic net income to value these. And if there are costs that are known, they should be included. So let's take a look at some of those costs that are excluded now. Okay. One of the key costs that's excluded is a big part of compensation. Let me read you something from page 103 of Carlyle Group's S1 filing. It's the same for Blackstone and KKR. We will implement equity-based arrangements resulting in compensation charges over future periods. Such charges will not be reflected in our calculations of economic net income. Again, it's economic net income times a multiple, let's say 8, that determines the value of each of these companies. Okay? They're excluding that. Okay? They're also excluding deal fees. Now what's happened is a lot of public pension boards have said, well, we don't want to pay deal fees because you're kind of rewarding yourself for doing these deals because you're the one earning the fees. So they've negotiated, KKR for example, said, okay, we're not going to charge you deal fees, we'll do an offset. So what they do is they take these fees and they push them down to these individual portfolio companies. Deal fees is a good example. So these fees are being pushed down to these portfolio companies, but they're excluding them from economic net income again, which greatly inflates the income, and you value these companies times the multiple. And so the question again becomes is, wait a minute, how are you able to legitimize earning carry fees over here when you're using grossly inflated values of your companies here? If these companies in the partnerships are overvalued, meaning that the partners aren't really entitled to the deal-specific carry fees, then the whole thing becomes a bit of a loop. They're recognizing carry fees that they're not entitled to. Public pension participants are being overcharged carry fees, and again, there's no disclosure of this. There's no independent record kept in Oregon regarding the total carry fees paid by partnership. So there's no capacity to really know. And again, we're taxpayers. This is a huge government contract. And there's been no media coverage of this whatsoever. The truth is, there are some good private equity firms out there, okay? But again, there are so many that are abusing these tax rules, using arcane allocations. We really need to get on top of this. They need to be paying their fair share, and the place to begin is ordinary income rates on carried interest. That's a good place to begin. In addition to that, these private equity firms that have public pension investors, which ultimately we support as taxpayers, they should be providing them a summary of the total fees they're charging them on an annual basis. It is absolutely preposterous that they're not doing that. As a taxpayer, I'm a believer in the public pension system. I think public employees are entitled to a good pension. But this whole nonsense of cheating the public pensions, not disclosing key things, all this nonsense, it needs to stop. And it begins with transparency and disclosure, and hopefully with more disclosure related to these tax-related machinations and the way they're determining net income. Again, the place to begin is for the Securities Exchange Commission to tell the Carlyle Group, I'm sorry, you filed your S1, but we need you to refile it, and we need more information on how you're valuing your various companies, because this economic net income measure is simply not good enough. That's what they told Groupon. Now, if they're going to tell Groupon that in terms of how they're determining their net income, why wouldn't they say the same thing to the Carlyle Group? Thank you for watching.